Hi, everyone. It's John Pokeroba. It's December 2nd, and it's time for a general market update. I hope everybody had an enjoyable holiday over the Thanksgiving Day break. A lot of activity in the market, so let's get into it. I'm recording this at approximately 3:30 on Friday, so some of the charts may not be completely closed for the day. Again, reminder, this is a production of Rain King LLC, and I'm an amateur individual growth stock investor, and I'm not affiliated with MarketSmith or IBD, but I've been trading for over 18 years. So we'll talk about the big picture. Then we're going to get into some breadth of the market, a little bit of relative strength, where the activity is, and then talk about the indexes in this rally so far. So big picture, this is the NASDAQ weekly chart. We've talked about it numbers of times. The 10,000 psychological level seems to have held from where we were back in October. So that's a good sign. So far, though, the Nasdaq as an index has woefully underperformed all year, and it's still the underperforming index against the Dow and the S&P. So I want to get into some breadth and talk about where some of the strength is in the market. So on the breadth side, this is the S&P breadth, New York Stock Exchange. So on the left, we have the 200-day moving average line, and we're looking at stocks, what percentage of stocks are above that line. We're currently at approximately 65% of stocks above the 200-day. This is actually the highest we've been all year since January. You can see that the peak that we ran into in early August reached 54%. Before that, the peak rally we had in March ran to 60%, and before that was 73% at the opening of the year. So this is the strongest level we've had all year, so that's encouraging. On the right is the percentage of stocks above the 50-day moving average. You can recall the summer rally that we had. We ran up to 92% by the August rally before it fizzled out at the 200-day line. We've run up strongly up to 91% currently and change. So again, this is a really strong thrust. We'll have to see if it can hold and see what's happening on the rest of the market. So again, staying with the S&P 500, on the left, this is actually the equal weight S&P 500. And you can see that what's encouraging here is the equal weight has been in an uptrend for a year. And particularly since the beginning of this year, the equal weight has been outperforming. You can notice also that as the index was coming down, the S&P, we got new highs before the index made new highs, the S&P index. So that's encouraging. And recently, coming in this rally, we are at new highs in the equal weight S&P versus the actual index. So that's encouraging. That's showing breadth of the underside of the market. So that's good. The New York advanced decline line is on the right. You can see the long-term downtrends has been in. We are headed in the right direction off the October lows. We're rising, but obviously there's work to do. We're still below the 200-day moving average, and we're still below the downtrend line. So it's not the all clear yet, but some of the other indications are showing good breadth so far on the rally. This chart I showed 2 weeks ago. This is small caps and mid caps. Small caps on the left, we talked about this push into the 200-day was running into trouble, where mid caps were actually above the 200-day. So let's look at how these charts have developed in the past 2 weeks. So I'm sorry, I mixed these up. I have the mid cap now on the left, but you'll notice that the mid cap is still holding above the 200-day moving average, so it's outperforming the S&P 500 as well as the NASDAQ. That's really good. Very strong sign, and we're actually trying to get above the August highs. So that'll be a good test for this index. And the IWM on the right, it's still kind of battling with the 200-day moving average. It's poked its head above it. It's come back down below it. So it's fighting. But again, small caps, to see them fighting is a good sign because earlier in the year, they were just getting wiped out. So again, this is encouraging that these two ETFs are performing. Now, I put this in the deck because I thought it was very interesting to take a look at the home builders, the HXB ETF, divided by the SPY, which is the S&P 500. Um, this is a little longer term chart. What's interesting, though, is this ETF, this comparison here, uh, bottomed out in April, and it's been making a series of higher highs and higher lows. And you can see the higher highs got noted in yellow. So it's been slowly grinding its way higher. And you'll notice that as it's making its peak, the broader S&P was making new lows. So it's showing some relative strength, not a straight up line. But what's interesting about it is home builders are extremely sensitive to interest rates. Now we've had seen very sharp increase in interest rates this year, yet this index is still grinding its way higher. So the market is a big discounting mechanism, and say, what is this telling us about what where we might be 6 to 9 months down the road? I think it's an encouraging sign to see the home builders divided by the S&P actually, believe it or not, in an uptrend. So I think that's an interesting data point. Now, if you take that one step further and say, well, what's happening with actual stocks in the HXB? And I just picked three of them out on the right side of the screen. This is DR Horton, Lennar, and I think it's NVR, not NCR. These are weekly charts, just a quick snapshot. Most of them are coming out of bases that broke out in the last few weeks. And you'll notice that the relative strength lines are starting to turn up. All of them are encouraging. And you get these are interest sensitive stocks. So it definitely looks like maybe they're starting to foretell 6 to 9 months down the road, maybe interest rates will start coming back down, depending on inflation. So interesting data point. Here is a sentiment survey. This is the American Association of Individual Investors. And a couple things I wanted to show. It shows the historical information, but here we are on a weekly basis that shows the last 4 weeks. Now, the red is the number of bearish percentage. Now, the number of bear percent has outnumbered the bullish percent for 35 consecutive weeks. And I've been told, or I read somewhere, that that's a record. So 35 consecutive weeks of bears outnumbering bulls. That's really interesting to talk about negativity. You'll notice that the gray bars have gradually been moving to the neutrals. So there have been some bears now moving into the neutral category. The neutral category is getting larger, but the bulls still leaving the building. You'll notice that the number of bulls, outright bulls, has been gone from 33 to 29. Now it's down to 24.5, which is a really low reading. So sentiment extremes like this usually occur at turning points. So it's just an interesting data point. And as a reminder, we don't trade off sentiment surveys. They're really secondary and tertiary indicators, but this is also painting a picture that we typically see around lows of the market. So let's get back to the indices. I want to look at a comparison here just to give people the perspective that the green line here is this is the 10-year yield, which has been rising all of 2022 for the bulk of the year as rates have risen. And UUP is the US dollar. The US dollar peaked out a couple of months ago. And more recently, we had a peak in the 10-year yield. You'll notice when those start to turn down, you'll see stocks, and I show the NASDAQ and the S&P, start to trend up. And since they really have started to actually come down and break their uptrends, at least in the last 6 months, which is a short-term chart, you can see we're starting to see some outperformance by stocks. So on the index level, the S&P is on the left. The green arrows indicate the initial follow-through day. We've had a couple of subsequent follow-through days. And as of an hour or two ago, the index was trying to close above the 200-day moving average. It would be a very positive sign. Well, you haven't seen a 200-day weekly close in quite some time. We did have a short pullback to the 20-day. And then we had the Powell speech on Wednesday, and we got a really strong day. So consolidating those gains would be very, very positive for the market. The NASDAQ is on the right side and have shown the follow-through days, a couple of really strong uh, subsequent follow-through days. We had about a 4.8% pullback that came back down, and we've thrusted higher on good volume on Wednesday, the Powell speech day. So, but we're still way below the 200-day moving average. Again, the NASDAQ is still way underperforming. It has a lot of work to do, but it's a good sign to see both of these indexes are trying to keep the rally alive. Now, what's really holding down um, the both indexes, the S&P as well as the NASDAQ, is really big tech, big cap tech, which is a heavy component in the NASDAQ and even has a significant size also in the S&P, have really been the sore spot. They have underperformed very badly. And that's why I showed the chart of the equal weight to show a little bit more that the broader market was stronger. Now, I asked myself quickly, usually it's strong when you say these big techs are above their 20-day moving average. So at a quick snapshot, you say which ones are above the 20. They're all above the 20, except for Apple and Amazon. So if these big cap 20s start to catch up to this rally and start to really move, we could get this rally to really get another gear, go from second gear to third gear. If we get a rally in some of these big cap techs, but that remains to be seen, but that would be a very positive, particularly for the NASDAQ. So I want to follow up and do a follow-through day signpost update to what my last video was a couple of weeks ago. So I mentioned before, there's been 6 major bear markets since 1971 using the S&P, and the average length of those big bear markets was 536 days, and they averaged a depth of 39.8%. So our current bear market here in 22, we've reached 282 days, which is less than the average bear market, a major bear market, and the depth is 27.6%. Now, the signpost that I flagged 2 weeks ago for people was when you finally, we have a lot of failed follow-through days in bear markets, but when you finally get to a successful follow-through day that actually works, coming out and ending that bear market, a couple of signposts we look for is the average gain coming out of those successful follow-through days is a 6.46 gain in the first 4 weeks, and then another marker would be about a 12% gain in the first 13 weeks. And we also want to see shallow drawdowns. The max drawdown in the first 13 weeks of a successful follow-through day is 4.65% coming out of these 6 major bears. So it's a good way to kind of start looking at how are we doing. So 2 weeks ago, we were at a 4-week gain of 5.4% right here on the chart, which is slightly below the average, but still good. And we look at the pullbacks. We had a 5.4% pullback, we had a 3.2% pullback, and we had another shallower 2.4% pullback. And then we had this thrust above the 200-day, of which the challenge is, can we hold that to close today, as well as can we hold it in the coming weeks to see if this rally has more legs. So, the gain to the peak from the follow-through day so far, and we're at 6 weeks, is 9.3%. That's very good as we move towards trying to get to, historically, you could get to 12% in the first 13 weeks. So that's good. That's good pace. The breadth is looking decent. I have to say that the market is still extremely volatile if you're playing anything with a growth name orientation. They're still extremely volatile, so it's very hard to hold them and build bigger positions. So it's really challenging to try and work with growth stocks still. Still, I think the market warrants some exposure. We talked about putting your toe in the water, and if you're having some successful positions, you could be 15 to 25% exposure in the market right now, but you got to keep your risk controlled at all times. It's still kind of a go slow environment, but it's encouraging that some of these signposts so far are looking pretty good. And the thrust that we had on Wednesday actually was what we call a Eureka thrust, which we had a really strong advancers over decliners. as well as the up volume on the advancers versus the down volume was very, very strong on Wednesday. So that's a good sign. It wouldn't be unusual to see a few days of digestion of that. We're kind of at a critical juncture. The S&P has a downtrend line we're trying to get through. We're trying to get through the downtrending 200-day moving average. So there's some challenges ahead. So it might take some time, but this is definitely a good encouragement for the week. So going forward, I think it's probably understandable that the Fed probably does not want to see a strong market rally. Uh, the reason being is if the market starts to make some significant gains, that means people's personal wealth is increasing, which means people probably are more inclined to do spending, which eventually more spending at current levels would make inflation sticky. So the Fed probably does not want to see a strong rally. So I would not be surprised at all if we saw some of the Fed governors talking down the market as they did on Monday, Tuesday of this week, and even Powell may talk down the market next week. Now, we know the market looks 6 to 9 months ahead. It's a discounting mechanism. We have seen bond yields starting to curl down. That's a good sign. And I mentioned home builders, which are very interest sensitive, um, showing some relative strength, which is encouraging. But we don't follow the news. We follow the action of stocks. That's why we've been looking at the charts. We're not going to follow the talking heads, and that includes um, even the Fed governor's talking heads. We want to follow the action of institutional investors where they're putting their bets down in terms of sectors and stocks. So is this a bear market rally or is it a new bull market? We don't know. We don't need to know. What we do is follow things day by day. The New York Stock Exchange breadth has been continuing to improve, so that's encouraging. The AD line still needs to get through some downtrend lines. You mentioned the key levels out there for some of the S&P 500. So it's definitely, you want to have some exposure to the market to test things, but I do stress being selective. Make sure that you're not in very thin stocks. They're very volatile. Um, I think you want to really try find stocks that show relative strength. They want to have earnings. They want to have sales. You want the best merchandise because you're trying to build a position. At least I'm trying to build a position, and you want to find the next big monster growth stocks that will lead the next bull market. Now, if this rally continues, we'll start to see even more stocks setting up. We'll see more breakouts, and we'll see breakouts start to get some traction and not reverse immediately. Will there be positive price action going on in the market? So we want to see that. If the rally fizzles, we back away. We protect ourselves. We reduce our exposure, and we have to remain very, very flexible. It could be a bear market rally. Who knows? But right now, we take it for what it is, and it's encouraging that some things are starting to work. So we want to be open to that. So to wrap up, I just want to let people know I've been giving these general market updates for approximately 1 year, slightly over 1 year now. It's interesting that I started right as the bear market started. My next update will probably be in 2 weeks. And I thought it'd be interesting. I'll do a 2022 year in review. We'll talk about some of the winners, some of the losers. There were 2 or 3 rallies this year that if you were in the right sectors, you could have made some money. But as we all know, as growth stock investors, it's been extremely challenging just to hold on to the portfolio that you have. Most of us probably have losses to some degree. Hopefully your portfolio is not drawn down too far. There are some interesting tweets that I've made along the year. Well, let's take a look at those and just wrap up the year. So I'm looking forward to that. I'll put together something maybe that's fairly interesting for people. If you don't follow me on Twitter regularly, here's my handle. Here's my YouTube channel. And my new email, if you want to communicate with me about the videos or you have a question, please reach me at rainkingbullbear@gmail.com. And I look forward to seeing everybody on the next general market update. Have a great weekend.